Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Remember, if you want daily market insights or pro picks right to your inbox, go to our website, inthemoneypod.com, and smash that subscribe button. On today's episode, we've got Brian Belski on the show. He's been investing since the 1990s, and he's become a household name for anybody who has followed the financial markets as the Chief Investment Strategist at BMO Capital Markets. And he is often known as Bullish Brian Belski, but people forget that he made his career in 2007 when he was among the first people to call for selling U.S. banks. Of course, we all know what happened after that. Today's episode, he is full of big calls, including why he does not think this is the end of U.S. exceptionalism and why he calls Europe a value trap. And he's full of a bunch of little pearls of wisdom along the way. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're looking to explore the world of options trading, having the right tools is essential. The BMO InvestorLine self-directed platform offers a suite of features designed to help you analyze opportunities and execute your strategies effectively. Discover advanced charting, real-time quotes, strategy builders, and risk management tools, all within the powerful platform. Take control of your options trade and explore their potential with BMO InvestorLine. Start investing today at bmo.com/investorline. Brian Belski in the flesh.
Amber, where are we? Hi.
Hi, this is my studio that a lot of people think is in my house, but it's not. Can you please verify we're in a professional setting?
This is so professional. I felt like I had, security check me, and it's turnstiles, there's an ID, the whole shoot and match.
The whole shebang. I appreciate you pumping my tires there because I actually think of you as somebody who's got a naturally sunny disposition.
Oh my gosh, thank you.
And whenever I talk to you, bullish Brian Belski. Is that right?
Yeah, so I was in Naples, Florida, where I lived 7 months out of the year. By the way, I like to tell stories. I think life is about stories and investing is like stories. So life is like investing. Anyway, so my family was down for the New Year's holiday, and we were at the pool at this place where I belong to across the street from my house. And I'm sitting there, and all of a sudden, Stuart Varney walks by from Fox Business News.
Yeah.
And he probably had a couple pops, and he looked at me and goes, "Bullish Brian Belski." So
I thought I made that up.
No, every time I'm on the show with him, he says that, and then the cat was out of the bag because I was trying to keep it on the down low about what I do, but then all of a sudden, whatever.
So you get this reputation as bullish. Mm-hmm. You got to backfill it for me. You must think of there's so many times of panic. Even in the last year, there's so many times of panic. And how do you hold on to your resolve?
Well, people that know me well know that I'm a man of faith. Faith is a really big deal for me. And God asks you to do a lot of things. So God supremely commands you to act justly, love mercy, and walk humbly. You're not supposed to know everything. And when I walk into a room, I know I don't know everything. And I think too much in our business, meaning financial services, whether or not it's Bay Street or Wall Street. And I think it's really magnified since COVID. The people that do what I do, meaning strategists or run money, they think they know everything and they want to make these big calls, and there's so much narcissism. I think narcissism is like one of the most overused terms of the last few years, just like dysfunctional family was in the 80s and 90s. Anyway, I think it's the faith. And what is faith in our business, meaning investing? It's fundamentals. And I believe the fundamental construct of the United States stock market and the Canadian stock market has not wavered. I was very blessed at a young age to meet Warren Buffett. And he told me, he said, "Brian, never buy anything unless you can reach out and touch it." And I've lived and died by that. And so I think in investing, you want to be able to experience something. You want to be able to literally reach out and touch it and understand it. How does it impact your life? And that's why, for all intents and purposes, aside from a time when I was at Merrill Lynch and ran an international portfolio, which was really hard for me to do because I wasn't able to walk into the Couche-Tard store, right, or whatever, at the Circle K. That was hard for me. So I think investing is like life. You have to kind of experience it. Many people forget, though, that I was the very first strategist to go to a sell on financials in 2007. And my good friend and former colleague, David Rosenberg, was at Merrill Lynch at the time. He was the hotshot chief economist. I reported as the chief investment strategist. Rich Bernstein, many people know that name. But I was head of U.S. strategy and sector strategy. So back then, we would make pair trades, meaning buy one sector, sell another sector. So I still think it's the biggest call of my life to go to a sell on financials because of what that ultimately almost took down our entire industry, let alone our economies. Anyway, I made the call from all places, Canada. Many people don't know this. So I was out in Vancouver, institutionally marketing, meaning seeing institutional clients, and it was just bugging me. So I wrote the report from Vancouver to Whistler. I was there in town in Whistler to speak to the Canadian Traders Convention in August of 2007. It was just bugging me. So I published the note. It came out at 3 o'clock in the morning Eastern. No, 3 o'clock in the morning Eastern. I had to get up at 3 o'clock in the morning Pacific time to lead off the morning call at Merrill Lynch that day, saying Merrill Lynch is going to a sell on financials and we're going to buy technology. Think about that. So technology was massively out of favor and everybody loved financials. I mean,
and what was bugging you? You said it was bugging me. I needed to do it. Like, what did you see at that time? Obviously, we know what happened. There
are relationships in this business in terms of how sectors work. In the sector, the financial sector in the U.S. was being non-correlated, not as related to interest rates, the change in the 10-year Treasury slope, and more related to credit. Like, this is not going to end well. Plus, everybody loved financials. Plus, it was the only sector in the U.S. that had a lot of growth. Now remember, post the tech wreck of 2000, investors left the United States. Retail investors, private wealth investors, got crushed by tech stocks because their asset allocation was out of whack. 90% of their asset allocation was in equities, 10% was in cash and bonds. But of that 90% equities, 100% were tech. And remember, everything went up. You just buy it, throw a dart in it, right?
Yeah.
And so that crushed the semblance of stock investing. Then you think about the euro came out synthetically. You could trade it in the late 90s, and then you could actually reach out and touch it, right? Then Europe got hot. Then commodities got hot. Then emerging markets got hot. Then was death to America. Then we had 9/11, and we had a couple of recessions, and everyone was making money everywhere else in the United States, except for financials. Now
except for tech, you mean?
No, except the only place that was working was financials.
Yes.
Okay. I, like most other people on Wall Street, never made any more money than I did in 2007. I mean, that was the year. I remember when I got my bonus check and I'm like, you're paying me this? Wow. I mean, like a kid from Minnesota. I'm like, what? Anyway, so I was, from a contrarian standpoint and from a nervous standpoint, from a sentiment standpoint, I said, this cannot continue. So I went to the sell, and then again, so I lead off the morning call. That was the day, by the way, that effectively the Fed opened the window and started QE. And so
quantitative easing,
I'm sorry. And then the market was up 2% that day, and financials were up 4%. Oh my God.
Worst call ever.
I'm like, I'm going to get fired, man. I'm going to get fired. And so I did the speech at the Fairmont.
Did you get hauled in anywhere?
Yeah, here it comes. Ready? Wait for it.
Yeah.
So I'm in the car to go back to Vancouver to fly back to Newark because I was living in New Jersey at the time. I get the call from the head of research at Merrill, like, what is going on? And I said, Candace, she's still there, by the way. Hi, Candace. She said, what are you doing? I said, Page 2, exhibit 2, look at the chart. What do you see? And it was the relative performance of financials, decoupling from interest rates. And the next to it was reconnecting or being too correlated to the credit spreads. Silence. I'm with you, Brian. Click. Hangs up.
That's it?
That's it.
That's all it took?
That's it.
So I want to, I love this story and I love storytelling. You're doing podcasting so well already, Brian, A+ student, because I want to cut you today. And I feel like it's almost the opposite where tech all the way. And I know that's starting to change, and maybe financials, with a few exceptions like the JP Morgans of the world, like the sentiment is not as hot around financials, but the sentiment is really hot around tech. Yet it seems like you're still bullish on that sector.
Yeah, we've been through, I'm in Canada, so through our process, we look at a lot of different things, and which has led us to not be as concentrated. There was a Minnesota accent coming through there, concentrated.
Canadians will be used to it because it's kind of
like that. I also say roof. You know what that is? You know what a roof is? That's
is
what we
it
say.
A roof?
Yeah.
Not a rough rider.
Or coffee. That's how I say it. Anyway, so I'm actually in the money that we have the very great fortune of running for BMO Wealth in the US and Canada. We're actually underweight the Mag 7, but we've outperformed dramatically this year and last year. And the reason is that number one, you don't have to own everything. It's called stock picking. And you want to be more selective in terms of what you buy, how you buy it.
I want to pick up on that point, stock picking. Everybody loves to say it's a stock picker's
But they don't
market.
understand it, man. They don't get it.
Let's help them understand a stock picker's market, because you did some work to show the S&P is flat, but tell me the number of stocks that are outperforming.
Yeah, so the average number of stocks, the majority of stocks are actually outperforming, and that tells you that the unweighted, the equal weighted index is doing better. The fancy way from a quantitative analytical say, there's this thing called standard deviations, which measure the price differentiations within a particular subset, whether or not we just lost everybody. What is he talking about?
Well, don't worry, our audience loves standard deviation
within a market or a sector or a group. The wider it is, the more you want to be stock picking. If it's really tight, then it's just buy the index. I mean, what are you adding any value? Right?
Why did you go underweight Mag 7? Because they have been underperforming.
We went underweight because what we saw in our work that anytime the market is massively concentrated like that, it can go for a while, but then it really unwinds, number one. Number two, our fundamental work in our stock picking says, I don't need to own everything, right? The way that I differentiate myself is that I play themes and how I look at stocks. So whether or not it's a value theme or a contrarian theme, the number one investing book that I've ever read is The Art of Contrary Thinking. It has nothing to do with investing. When everyone's going this way, go the other way. Like, do I absolutely need to own Google and Meta at the same time? I don't know. I don't think I have to. Or do I have to own Amazon and a bunch of other retailers? No, you don't have to. You have to pick and choose. Like, for instance, in the consumer staple sector, the best consumer staple stocks aren't even consumer staple stocks. It's Costco and Walmart, right? The way that we used to think about that. So it led us to say, let's be more concentrated. Let's make bets. This is how we do things. When I go talk, my principal job is to talk to institutional accounts. So I was in JP Morgan Asset Management a couple of weeks ago, and I'm having this meeting with like 15 portfolio managers, and not to be ageist or anything like that, but a lot of them are the Gen Zs and millennials are in there. And I'm saying, we're going into a stock picker's market. I got this blind stare at me. They have no idea what it is. So you're looking at company managements, the product or service, earnings, valuation, operating performance, track record in terms of what they do. It's not just, hey, it's going up and I'm going to buy it. And so again, going back to what I said really, really early on about since COVID especially, everybody wants to make the big call and there's no original thought. I like the market. I'm just going to go with spiders. Well, we've proven through our work and the way we've been very fortunate, excessively fortunate, that through this big bull cycle, we've outperformed the broader index because of the stock picking work that we do.
So you're not really bullish, Brian Belski, like you are maybe in essence, but you pick your spots. You're not just blindly you're saying buying the SPY,
correct,
overweighting the Mag 7. You choose when you're going to be tactical.
Correct. So for instance, let's use a baseball analogy, like a sport analogy. Okay. There was this hitter in the 1980s and 90s by the name of Rob Dibble. Rob Dibble hit like 210, but he hit 40 home runs every year, but he'd strike out a lot. I don't want to be Ron Dibble. You know who Ron Dibble is? Kathy Wood. I love Kathy and known her for a long time. Kathy, hi. I don't hit home runs. I'm not into it. I'd rather be Rod Carew. Rod Carew was a player from the Minnesota Twins. He stole home every once in a while, which is exciting. Hit lots of singles and doubles. If I can hit 340, I'm good. So my job, if I'm right more than I'm wrong, I'm fantastic. And so we've had a really, really, really excellent run here and been very blessed in terms of how we do things.
So I'm going to hit at you with some of the things. People are calling this rally because it has been a rally kind of post-Liberation Day. Everybody kind of collected themselves off the floor and decided to get back into stocks. And, we used to talk about the rally post-2008 as the most hated rally. And I feel like maybe this is second or now first place. It's an unloved rally. That's what I hear a lot of people talk about. And one of the reasons is valuation. The market is too expensive. What do you say to that? Well, and we're talking about the U.S. markets here.
Yeah. So again, another story for you. So the most hated, climbing the wall of worry, the most hated bull market in history, off the 666 lows of March of 2009. I fed off of all of that at that time, and that's what actually helped me define and discern my call, which I brought to BMO when I came to BMO 13 years, 2 months, 3 weeks, 4 days, and 12 hours ago, that U.S. stocks have entered a 25-year secular bull market, and Canada's come along for the ride. At certain points, we can talk about that in a bit. But at the end of the day, I think this, unfortunately, I think people have been too wrapped up into their personal views and their emotions surrounding the President of the United States and what's happening in terms of U.S. policy. And they started to believe their own BS with respect to the American exceptionalism trade is over. And again, let's go back to what I said. If you want to buy companies you can reach out and touch. I challenge people saying, you find me 10 better companies than 10 best companies in the United States. Find them. You're going to go to Europe? Okay. They make chocolate. They make conveyor belts, Siemens. They make weight loss drugs. They make telephones. What else do they make? Not a lot. I mean, you can go there I know a lot of Canadians are going there on vacation because they don't want to go to the United States because their personal views. And by the way, Air Canada knows that, so they jacked up all the prices.
Yeah.
I mean, come on. Anyway, so I think anytime in life, again, life is like investing in life. Anytime that you base your investment decisions on emotion and not analysis, it's going to fail.
So you don't think this is U.S. exceptionalism is over?
No. So I don't, because let's go back. The big bull market, I believe, started in March of 2009. Now, people will argue with me, but let's just I'm just a simple kid from Minnesota. That was the bottom. And within secular bull markets, which we've talked about in several reports the last 13 years at BMO, you can have cyclical bears and cyclical bulls within the big giant trend. One of those cyclical bears bottomed out in November of 2021. It was within 3 months of the secular low in the US dollar. Think about that. So we talked about how everybody owned everything but the US starting in 2000, the 2000s, really until 2011. And then that's when foreign investors, non-US investors, I believe, between 2011 and literally Liberation Day, or whenever Trumpy got in, they were quote unquote reluctant buyers of U.S. stocks because they had to buy them because they had to perform. Now, you also think about the structural issues that investors in Europe had to do with all these rules, and they can't buy energy stocks, they can't buy this, and they massively underperformed and blah, blah, blah. Anyway, I was in Europe in April, and I was visiting with a very large institutional account. And the greatest thing about this business is no matter how much you try to mess up this business, it's a relationship business. So the majority of these people I've known for 20 years. And we have an amazing institutional practice in Paris in particular, some in Paris. And they were giddy, man. They were giddy.
Too giddy?
Giddy. Belski, I'm this little Pepe Le Pew. what do you think of our European trade now? And I said, oh, okay, well, I said, I'm going to ask you 2 questions then. And he said, okay. And I said, do you believe in my simple math equation that stocks lead earnings, which lead the economy? Stocks lead earnings, which lead the economy. We. I said, okay. I said, my follow-up question is, I said, do you believe that the European stock market as an asset has the earnings growth and the economic growth to back up the price performance?
What'd they say?
No. And I said, okay, sell. So from a valuation perspective, I didn't answer the question. Valuation is the worst metric in terms of forward performance. Now, do I believe that the U.S. market over the next 3 to 5 years is entering into normalization, which would see something like a 15 to 18, 19 multiple? Yes, we said this in print 3 years ago. I said in this report that I wrote 3 years ago, I said the U.S. equity markets around the world need to be shocked into normalization. I didn't know it was going to be tariffs and all this kind of stuff, obviously. But we were in the process of being shocked into normalization. So what does that mean? High single digit, low double digit performance, same thing with earnings growth, average multiples 15 to 18, and a 10-year treasury between 350 and 450. Boom. That's normal if you go back and look. Now, we have not had a normal environment since the mid-90s for all intents and purposes. So I think we're going that. So I think we're going there. So the last 10 years of this big secular bull market will be much more normal. In a normal investing environment, you want to own a little bit of everything, not just large cap stocks, not just concentrated tech stocks, some small cap, some value, some large cap, some Canadian, some international, some whatever, and not just be so concentrated. Because if you think about it, think about the March low, March 20th low, March 23rd low of 2020. Okay. And how much that was U.S. stocks just crushed it on the way up. Think of how in 2022, U.S. stocks got crushed because of inflation, right? And the bond market was rolling over. And then 23 was an oversold rally because too many people sold too many tech stocks. People forget about this. And then 2024 was the AI rally. It was tech, US. Then Trumpy came in and ruined the party and everybody got emotional and they started playing their personal feelings with respect to the president of the United States. And now they've had this big unwind. So going back on a near-term basis, I believe, whether or not they're climbing the wall of worry or not, they impressed and imprinted their personal feelings onto how to invest.
And so you've already said that you don't think U.S. exceptionalism is ending, so don't sell all your U.S. stocks. But it sounds like you're not lured in by the low valuations in Europe.
No, it's a value trap. So you think about this. What's a value trap? So this goes back to my Merrill Lynch days. You have a numerator and a denominator in a valuation. So it's prices on top and some sort of fundamental metric on the bottom. So it's earnings, it's book value, it's sales, it's cash flow, it's earnings. So that's why I was pushing these European clients in Paris. They said, okay, so on a valuation, it's cheap. However, what happens, this is just math, when the earnings number in the denominator goes down? That means the entire valuation goes up, right? That's a value trap. So they have to still put their earnings together. Now, that doesn't mean they're not going to. Do I think that there's a massive reshaping of the investment environment? Not massive, but I think it's going to be a situation where
there's more spending.
There's more spending, fiscal. Reversion to the mean. They've done a great job in terms of cutting interest rates, but they have massive issues with respect to government debt. You think we do in the United States or Canada? They've got massive demographic issues, entitlement issues that they have to continue to fight through. It doesn't mean certain stocks can't work. Again, stock picker's market.
For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. where does Canada fit in all of this? In May last year, you said time to overweight Canada.
Nobody believed us.
No one believed it, and they should have, because Canadian stocks have outperformed since then. But now I'm reading your notes, and it sounds like you think that trade is getting long in the tooth.
I do, and I can't believe that we've been able to talk about this. But a number of years ago, I think it was like 2014, maybe 15, I talked about the Canadian investor being the moral equivalent of the mythical creature Eeyore from Winnie the Pooh. I've said this in print, like I didn't get in trouble for it. Oh, it's sunny today, but it's going to rain tomorrow. That's a Canadian. And you think about the Canadian person, right? They go to Dollar Tree, which is an amazing company, right? They go to Dollar Tree even though they've cranked up prices for 8 or 9 consecutive quarters. Dollarama. But yet they think they're saving money, but they're spending more money. It's fantastic. And so we think Canada, from a longer term perspective, and again, don't hate me, Canadians, but as America goes, so goes Canada. Just it is what it is.
Even still in today's environment,
we're aligned. We're aligned. We're aligned from just a pure how close we are in countries. The trade's not going to go away. It is going to get worked out. It's going to be okay, right? It's going to be okay. But think about how interconnected we are. So Canada is going to have these times in the sun, and they have the last 12 months. So it doesn't mean that at year end, Canada, from a net perspective in local currency, isn't going to ultimately outperform the US. I just think its relative outperformance is beginning to fade.
Okay, I want to put together some of the bears that we've had on the show and some of the people who like to be in commodities. And if I can just coalesce their arguments together, it's, valuations in the U.S. are too high. It's been just too long of American exceptionalism. To your point, if you called for 25 years of a rally from 2009, like we've only got a couple years left there. And that commodity
10 years, isn't that pretty good?
That's pretty good, yeah.
That's pretty good. Who makes 10-year calls anymore? Anyway.
And that this is the moment for commodities. And commodity cycles come around like every 30 years, and now it's due.
Well.
Oh, sorry. And I'll just add one more.
Gold. Tell me about gold.
Sorry. We love to talk about gold in Canada, but the other thing is that the U.S. debt situation is like finally coming to a head. And so these are the catalysts for everything.
Okay, let's unpack this. I feel like I'm in therapy. Yeah. Let's unpack this. First off, fortunately or unfortunately, the Canadian stock market is not a diversified index. When we built our models, our number one attribute is the price of oil in terms of forecasting the TSX. What we found in our research is that anytime the price of oil on a year-over-year basis is negative, 85% of the time, the Canadian energy sector and the U.S. energy sector underperformed their respective indices, so negative on a year-over-year basis. So it's really difficult for us to be bullish on energy, given the fact that I know the whole drill baby drill thing, that's exciting, it's fantastic, but there's plenty of supply out there. Mm-hmm. The reason why oil's gone up here recently is because of the geopolitical stuff going on, which is probably not going to continue. It does not continue long. Speaking of that, for those people that want to put on the end of the world trade, the greatest line about the end of the world trade is you can never collect on it. Think about it. So it's a non-diversified index. I do believe, here we go, be shocked. I think at the end of this big bull market, we are going to have a commodity supercycle because we always do. And every 25 years, the loonie trades at a premium relative to the dollar. So the last time it did was 2012, 2013, something like that.
Yeah. I'm remembering because I was in university, yeah.
See where I'm going with this? And so I think that will also coincide with a brand new emerging market, Amber. In my view, it's not China and it's not India. It's something else that we don't know. We don't know what it is. If I knew, I would not be here. I'd be trading it on my own. But it's going to be something else that nobody knows.
Is that in 10 years you're talking?
Yeah, within the next 10 years, later in the 10 years. And then the U.S. will definitely underperform for a number of periods, not just 3 months. Oh, my gosh.
3 months does not a trend make.
No. I mean, come on. Anyway, so I think it's going to be when people don't expect it, because you have one predominant theme that is causing this unwind or this feeling, want, and need of American exceptionalism be over, and it's the hatred for the president. And get over it. I mean, I think that's ill-fated and ill-willed. You should not be doing that. From a fundamental perspective, on the debt side, America's done this with debt. And remember, we were the
up
budget
and down.
Yeah, up and down. Sorry,
It's an auditory.
Isn't this a video thing?
There's video, but there's also
up and down. We had this huge increase in debt to GDP. Outside of COVID, the largest increase in debt to GDP in U.S. history was during the Kennedy administration. People don't want to talk about that, but that was true. Then we paid off everything in the late 90s, balanced the budget. Okay, then 9/11 happened, and then the spigots were open, and then it was like on both sides, spend a bunch of money. Now they started to get some quote unquote religion. Then everybody hates Doge. Everybody hates Doge. Everybody hates Musk and da because again, politics. Versus when you take a look at a company, Amber, don't you want to buy a company that's cutting costs, making things more efficient, and earning money? Yeah. So that's all that the federal government was trying to do, but we can't do that but I do believe from a debt perspective, it only tells you that interest rates can't go much higher. Okay. Let's put an investment solution to this. Interest rates can't go much higher because of the debt levels. And if you start to see even more tax receipts coming in from you cut corporate taxes, you will ultimately have more activity come in because the revenues get bigger. More revenues pay off the taxes.
Add to that monetary policy. We just got another rate decision by the Federal Reserve. For a fourth meeting in a row, they did not cut rates. And I think this is starting to really aggravate U.S. President Donald Trump. But I hear more people beyond just Trump calling for interest rates to be cut. On one hand, we've had inflation readings that are coming in below expectations. But as part of this Fed rate decision, the Fed decreased their their U.S. growth forecast and increased their inflation forecast to now 3%. Is the Fed out of step with the market?
It's a great question. I'm going to try my best to answer it. Everybody says that President Trump does not like Jerome Powell. I'm not so sure of it. Fed issues with presidents go back several decades. There's this famous story about Lyndon Baines Johnson inviting the head of the Fed to his ranch in Texas. I can't remember the name. If Rosie was here, he'd be able to spew it. Of course he would. Hi, Dave. I love you. And there's a famous story how Johnson throws the head of the Fed up against the wall and said, cut interest rates. This was during the Vietnam War. It's a true story. Nixon did it. Reagan did it to Volcker. And so this is not new news, but of course everything's exacerbated because of the information age and because it's President Trump. Anyway, remember the Fed has a dual mandate.
William McKenzie Martin.
Bingo.
The magic of AI.
Magic of the internet machine.
Yes.
They have a dual mandate. And I think, and again, I didn't have time to read the notes or listen to the press conference, but clearly this is just looking in the onset, this is a message from the Fed that they're worried about potential inflation from tariffs and a slowdown in the economy. But unemployment remains, stubbornly low. And think about this. If you take, let's just call it 5%. 5 from 100 means 95% of Americans have gigs. I go back and look at things and what I've said before. And I remember I saw a clip of me on television from 2011. I looked terrible. It was a tough year, I remember. And I said, if we could just get unemployment below 11%. I remember saying that. Think about that. That was just a number of years ago. Mm-hmm. So again, we lose perspective, I think, a little bit. So the Fed has a dual mandate. I'm not quite sure. I'm not living into the rhetoric that President Trump wants to fire Powell. I don't get involved in any of that emotional stuff. I'm just trying to, if any kind of dislocations with the market happen because of volatility with respect to the Fed, I'm going to use that accordingly in what I'm going to invest in.
And generally, actually, the markets were resilient when the Fed made that decision. They're up because at the end of the day, regardless of what they said, they maintain their forecast for 2 rate cuts at some point this year. And I think that's what the market has priced in. Is that key to your bullishness? Like, do rate cuts need to happen in order for you to remain constructive on U.S. stocks?
Well, people that have heard me speak before know that I like to poke fun of the 14-year-old hedge funds that only buy stocks because interest rates go down. That's actually not a good thing. What if interest rates go down because it's a bad thing? Maybe the Fed's cutting because it's a bad thing because they see something that we don't know. Again, this goes back to the humility part, right? You have to have humility in this business. You have to come at it with like, what do they know that I don't know? Instead of, oh, I got it all figured out. They're cutting rates. We need to buy stocks. I think that's dangerous. So again, what if they're cutting rates because of something in the economy that we're not seeing? And you don't always have to be the smartest person in the room.
What do you tell your clients about tariffs?
First of all, not to poke fun of the media, the old school media, but fear sells. I'm just going to say this. There's certain networks where their ratings have never been higher because they're scaring people because of tariffs. Prices are going up. Well, first of all, let's take 2 steps back. How do you know that the price isn't going to come from the producer or to the consumer? You don't know that. That's number one. Number two, we don't know the exact tariff. We don't know until we know. And number three, what we believe is, taking 2 steps back, is, again, emotional regarding President Trump in terms of how he's communicating to us. This is classic art of the deal stuff. People don't like to talk about it, but this is what's going on. What I believe is happening is we're reverting to the mean. He's trying to just revert to the mean. What that ultimate number, Amber, is, I don't know. Actually don't really care. But what I ultimately think is going to end up happening is it actually reinforces our longer term view of, you got to own a little bit of everything. Don't be so concentrated. And I think the return structure of stocks is going to be held down a little bit more.
You know, we've been hunting since the pandemic for a recession. And now, instead of doing that, we're hunting for inflation coming from tariffs. And I wonder if we're going to be hunting for inflation the way we were hunting for a recession. It never showed up because, you know, we just got a recent read of retail sales in the U.S. and they were not great. And so that means if you're trying to sell something, you can't jack up prices, right? Because the consumer is not there, not willing to absorb it. So to your point about, we don't know who's going to absorb these price increases, if they are in fact permanent. Like, do you think inflation could end up being that thing we never quite catch?
The Chicken Little waiting for Godot?
Yeah.
Maybe. You think about the U.S. consumer is amazing. Canada's second only. Even though most Canadians are cheaper, they still spend money. Americans spend money like drunken sailors, but they're really smart about it. For instance, they may not be going to certain retail outlets anymore, but they're sure as hell going to Costco every Saturday, or they're going to Walmart to buy their groceries. They're not going to Target because they don't like that. And they're becoming very selective. They're still spending $100, but they're going to be very concentrated and deliberate about where they spend their money. They will sit in line at a Costco gas station for 2 hours thinking that they're going to save money. I mean, that's just the way that the view is. I mean, Costco, top 25 company in the world. I mean, it's an amazing company. But at the end of the day, I think the consumer remains very at the heart of the economy. So too are small mid-cap companies.
We are going to talk about that because I'm sure people are saying, what about AI? Where is he investing? Don't say it. We're going to take a quick break.
Let's take a break, everybody. Let's take a break.
We'll take a break and we'll get into it in Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's Capital Markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, now we're going to find out Brian Belski's highest conviction areas of the market. So exciting. So I didn't talk to you about AI on purpose because I knew that you wanted to save it as a high conviction area, but maybe not the obvious areas. How do you think about the AI trade?
No, I think everybody wants to talk about semiconductors, which I think is at the forefront. They're the connectors. literally. And then you have software companies, which are really the facilitators, I like to call them. But I think, and then other people too, it's interesting, want to talk about how utilities are, how are you going to power these? So I always ask people questions to get them to understand kind of the way we think. So with respect to utilities powering AI, I go back to, I always ask people, so do you know what the largest alternative energy company is in the world? Do you know?
Is it an oil and gas company?
It is.
Is it?
You're so smart.
No, is it like Exxon or BP?
It's BP.
I didn't.
Oh my gosh.
Well, I should do this for a living. Man. I should maybe do this for a living.
British Petroleum is the largest alternative energy company in the world. They spend more money on alternative energy than the entire publicly traded market cap space of alternative energy companies in the world.
For now.
But think about this. So then let's play that on utilities. Everyone's trying to figure out who the next power generator is going to be. The way to think about it is think about OG utility companies like Southern Company or Duke or the old-fashioned ones, NextEra, or even here in Canada, Fortis, because they have the infrastructure and literally own the power grid. But I think so that's a theme that people talk about. I like to talk about things that people don't talk about. Let me ask you a question. Do you have a phone?
Yeah. Always.
Have you texted during this interview somebody because it's boring, right?
Never. I was like, you can't believe what brother just said.
So all I'm going to say to that is they know where you are. Okay.
Who's they?
They. So how do you combat they? Yeah. Cybersecurity.
I think you have to say it louder.
Cybersecurity. Can you hear me? Is this thing on? Cybersecurity.
Okay. So I think that's the high conviction idea, cybersecurity.
Yes,
for
a
AI.
theme of AI is cybersecurity because you have to protect everything. So what are, names like in terms of themes would be like a Palo Alto theme or a Checkpoint, and Cybermark. These are companies from that perspective that I think are only going to literally power the protection of AI.
Because the AI is getting so creative. I mean, your pal David Rosenberg, there was just a report about how AI basically like used his likeness to defraud a bunch of people. So you're going to
scary. It's scary. So again, that's why it's so important to only buy companies and invest people that you can actually reach out and touch and have a relationship with.
Okay, so that's your AI trade, is look at these cyber security companies potentially. You mentioned your big call, start the podcast, your big call, 2007, sell financials. And here you are, 2025? Yeah,
I think so.
That's our 2025. Buy financials.
Yes. Now in Canada, most Canadians don't understand the U.S. banking system because you have 5 banks here and another one. In the United States of America, we have 600 publicly traded banks and 4,000 banks overall. And so our major theme there is scale and relationships. What does that mean? So the big banks, whether that's JP Morgan, Morgan Stanley, Goldman, Bank of America, Berkshire Hathaway. I mean, these are big scalable businesses with multi-divisions of assets, right? So it's wealth, capital markets, personal, commercial, all this kind of stuff. And so they are much better positioned for, I think, going forward relative to the regional banks. But you're a parent, right?
Yeah.
So sometimes we have to overcorrect our children, right? When we're parenting, we've overcorrected financials because they've been held down too much.
The large caps or even the regionals?
In general. So in regionals, I think are going to have a really hard time competing. So I think, what does that mean? So I think the trend going forward is going to be deregulation. So I think that's ultimately going to cause consolidation. So these regional banks, these non-money center banks can actually compete with the really big ones. Now I want you to think about something completely different. The relationship side of things. I think the small financials in the US got a bad rap because of what happened in 2023. Now, the banks that got over their skis in 2023 were an ATM card for the private equity companies. They weren't. Mom and pop in Palo Alto, California were not going to the ATM machine and pulling out their cash. It was private equity, right? So the small cap banks in the United States have become pristine assets in terms of their balance sheets and their cash flow, and they rely on great relationships. So the corner bank in America that's a publicly traded company is going to get the commercial loan from their buddy across the street way before Citibank or Chase or a Bank of America is, because of the relationship. So there's a theme in the small cap financial world too.
Don't you need a healthy though credit cycle? And like, regardless of you saying tariffs, they'll be fine, everybody chill out, it does create a paralysis. And so people aren't sure, should I invest? Well, in the US, you probably should invest in making American jobs because that makes somebody very happy. But you're not necessarily sure. Well,
the credit markets are actually amazing. They're showing no chinks in the armor at all. And spreads have held in there quite nicely. Again, you think about how everybody thought we're going to have a commercial banking crisis, a commercial real estate crisis. How'd that go? That never happened. Thought we were going to have a real estate crisis in Canada. How'd that go? It didn't really happen. So again,
you have pain points. Let's be clear.
Of course, you have pain points, but again, you can go back.
Widespread crisis.
Exactly, you can go back to real estate. It's all about location, right? And I'm not a real estate person, but that's the way that it works. But in terms of the credit side of things, credit's very available. By the way, these banks are so much better managed than they were 20 years ago. And so I think there's a big cycle coming in terms of financials.
Your final pick, and maybe this complements that, is looking at small cap value investing is back. It's back, baby.
It's back, baby. What's really interesting is if you take a look at the number of companies that are below $10 billion market cap in the United States, it's straight down the last 20 years. So think about contrarian, number one. Number two is that these companies, relative to the way I learned them a long time ago in a galaxy far, far away, these companies, they grow their earnings consistently. Some of them pay dividends. They have great cash flow. They have better balance sheets. And I think they provide liquidity because people need liquidity, even relative to private equity is really exciting. Everybody wants private equity now. But at the end of the day, they're not liquid. And so I believe small cap companies provide that kind of liquidity relative to private equity.
I'm so glad you brought that up because everybody does want, get access to private equity and get access to private credit. Where's the transparency? Where's the liquidity?
They said the same thing about hedge funds in 2008.
And?
How'd that work out?
Not well?
Not well.
There you go.
So, again, I think history repeats itself. It's just different players. It's never different this time, but it's just different players like a baseball game. But at the end of the day, I think that fundamentals matter and the fundamental construct of the United States stock market, but then certain areas like within value investing or small mid-cap investing, to me and to my great team, look extremely interesting and ones that we continue to do a lot of work on.
So I'm looking at the Russell Value Index, and it has really it's struggled. It's kind of middling along. You see a breakout in this class of stocks.
Yeah, this is a longer term. This isn't a 2 to 3 week call. This is a several year call.
Gen Z wants their money doubled by the end of the week.
I did a speech today, and there were some youngsters in the crowd, and I always say, "You guys, Gen Zers." I said, "Okay, so if I say anything to make you mad, you're free to walk around the block, have some alone time. You can come back and compose yourself, have a little alone time. It's great." But I think you can play the Gen Z theme. So Gen Z versus, here's the theme for the consumer, right? So I push my group to say, okay, what are they spending their money in, these Gen Zers, right? So I think that Shake Shack, okay, is to Gen Zs what Chipotle was to the millennials.
It's the new avocado?
Yeah, man. My son was at university, we call it college in the United States. That kid spent more money at Chipotle when he was in college than I think any human being possible. But this is the way I kind of think. You want to think a little bit differently in terms of a theme on that.
All right. I like it. We'll call that a bonus pick.
A bonus pick.
Brian, what a joy.
Amber.
Thank you. Do you want the final word? I feel like you want the final word.
No, I actually don't.
Okay. You were fabulous. Did I forget anything? I don't think so.
No, listen, I am excessively humbled. I can't believe I've been doing this long. And it's been an amazing run at BMO. BMO's been great to me. This is a relationship business. I've met so many awesome people here in Canada throughout my entire career. And it's really interesting because we started off the podcast talking about me being positive, and I've taken a lot of heat. And I've taken heat in broadcast, but I've always tried to stay level-headed and have the humility hat, number one. Number two, to me, it's been so amazing. I've heard from stockbrokers, we used to call them stockbrokers back in the day, from stockbrokers that I knew from 1993, like when I first got on the sell side. I started in the business in 1990, but that said, I can't believe they're treating it like this on TV and we're with you, Belski, and all this kind of stuff. To me, that is so humbling that people would take the time out to find me to do that. But to me, that's why no matter how much we go through the crisis and issues and politics and all this kind of stuff in the financial services industry, this business is an awesome business and it's all about the relationships. So Amber, I think we have a pretty good relationship.
We do, yeah.
And so I'm so humbled to be on your podcast, and thank you so much for having us.
Well, I'm grateful that you chose to spend some time with us on a very busy day. And to your point, I'm grateful to BMO too. They are one of our sponsors, and they signed on before we even had a first episode.
See, that's forward thinking. That's leadership. That's what that is.
Okay, enough for BMO. That's enough. Thank you so much,
Thank you.
Brian Belski. Make sure you stay tuned to our next episode. We've got Noah Solomon of Outcome Metric Investment Management. He uses AI to make a lot of his investment decisions on a model that he built himself. We're going to talk about how it's working and what it thinks about some of your favorite stocks. You can send us a question. Email us at questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.